Hello, everyone, and welcome back to another episode of Trade with Conviction. I'm Felipe Elink Schuurman, your host today, and I'm pleased to be joined by James and Michael. Hi, hey guys, how are you?
Yeah, very well,
Hey
thanks.
Felipe, all good.
You're in the US, right, Mike?
I am. I'm in the US this week.
Sorry, I called you Mike. I never called you Mike before. Michael, sorry.
It doesn't. All good.
How's the heat over there? It must be is as bad as Europe, or
No, so we have a family place in Michigan, and the reason that my great-grandparents bought it was to escape the heat
okay,
and their allergies, their hay fever allergies.
okay. So you're doing the same, I guess, escaping
Yeah.
the heat. Well, and enjoy your time over there. As you can see from our outfits, we are in summer mode with all the heat. But the heat is not only in Europe, it's obviously in the headlines and everything that is happening around the world. In terms of the focal points, nothing really dramatically new, of course. It's Hormuz, Russia, and now the Red Sea. There's just so much to talk about. Let's start with the events and what's been the sort of like the main news over the last week. Obviously, the US-Iran standoff keeps escalating, I would say. Maybe not kinetically, but in the words and in the messages that are being thrown out there. President Donald Trump was talking about the economic D-Day, threatening the country with all kinds of new economic sanctions, the most crushing sanctions ever seen, also threatening every other country that would support economically Iran. This is nothing really new, but again, it's just more fuel to the fire. Obviously, Brent has been escalating over the last days, going back to 92, I think it is right now, or 93. At the same time, President Donald Trump found the time to threat another ally. In this case, it was Oman, threatening to bomb them if they got in the way. Now, this comes from Fox News, and question is, what does it actually mean to be in the way? I know that from what we hear, US and Oman are having separate conversations with Iran, although that's what is being claimed. But at the same time, the news agency, the semi-official news agency in Iran is basically saying that there are no talks happening between US and Iran right now. So it's all murky and, typical the situation with Trump and his tweets. But the reality is that, and if we go into the flows and in the real reality of the market right now, is that the flows have obviously collapsed. And there's many phenomenons happening with the different flows. No, we saw that Saudi Aramco, for example, was selling something like 4 million barrels to China, but a lot of it was done outside of the strait, mainly via Fujairah. At least that's what was reported by Reuters. They're calling it quite a rare kind of tender. We also saw Saudi Arabia exporting via the Sidi Carrier, which is the med side of Egypt, through a pipeline they have there. And very strong exports, something like 1 million barrels versus July via the Sumed pipeline. And the anticipation here is that we will see some cargoes lifted by Asian buyers via the Med route, but we're also expecting to see some European buyers. And there's rumors that there are 3 majors taking cargoes from there, which again is this diversification of supply. We also talk about China. There was a lot of talks last week about China coming back to the market. Is it for real or not? From what I gathered here from our colleague June, is that China is buying, but there is really no significant uptick visible right now. A lot of the increased crude import data was actually cargoes booked during that mini reopening during the month of June. The more important factor here to take into account and to observe is whether that October-November delivery is actually happening or not. And from what she's saying is probably not the case, or at least not a significant uptick. Similarly, China has been absent from the latest 8 ADNOC tenders from October-November loaders, which were picked up by other Asian buyers, mainly Korea, India, and Japan. In essence, what we're seeing is a big diversification of markets. And interestingly enough, we're also seeing that economically, so not just geopolitically, customers in Asia had to find other sources of supply, but actually now economically, we're starting to see that buying from other sources becomes interesting. So for example, WTI right now is the cheapest source of supply, or is cheaper than Murban for a November delivery into Far East. We also see some other North Sea grades such as Johannes Sverdrup and Forties landing into Asia at economical prices. So there is this sort of tension going on. and whether it's for logistical reasons or economic reasons. One of the losers here obviously is Iraq. There's rumors that there are discounts of up to $25 a barrel, obviously on a FOB basis, so question is how can you load it but obviously that already tells you how desperate they are to get their cargoes out. So obviously nothing dramatically new on the Hormuz side, but it's just we're not getting anywhere close to any kind of exit here. That's for sure. Without actually mentioning that what was it? The MOU they signed that expired, I think, on the 17th. No, I don't know why.
Yeah.
Is that correct? Yeah.
So yeah, and I would just say in regards to that economic D-Day that you mentioned, I think really the only material new item in regards to that is President Trump now has the UAE on board in regards to stopping the facilitating of payments from Iran. Yeah. And from the bit I read, the UAE was a big facilitator of how Iran got foreign currency. So if Trump is actually able to shut that off, and it did look like the UAE announced that this is the case, that will put further economic pressure on them. But as you say, it's tough to see what the immediate impact is in the short term.
No, I mean, it's definitely the case. We also saw UAE, how do you say this, deporting some Iranians recently or expelling some Iranians from the country. So again, an escalation kind of mode. Seems like the UAE is a bit more on the offensive when they separated from OPEC, and they started pushing their own barrels and monetizing on the current situation, whereas Saudi Arabia seems to be finding different ways of exporting, but remaining a bit under the radar when it comes to the tensions between Iran and Sunni countries.
UAE has felt the brunt of the drone and missile attacks. I mean, it's in the thousands now.
Yeah.
And you really kicked it off with crude, Felipe. So if I can jump in with just some interesting things on the DPP freight side then.
Sure. I mean, there's obviously more to talk around Russia because that's a diesel story, but let's do that. Let's talk about the impact of crude and DPP. Then we can come back to Russia because obviously it has a bigger impact on middle distillates, and then we can move on to the middle distillate section.
Yes, please.
It's a good segue because TD6 is CPC to Med on a Suezmax, and those rates have skyrocketed recently. The risk premium now is huge to load any crude in the CPC area, and owners are ballasting their Suezmaxes into the Med for that reason, and because there's more demand now out of the Red Sea to then carry your barrels north through the Suez Canal. And what that's done over the last couple of weeks is it's cut the tonnage counts out of the US Gulf Coast and out of WAF for Suezmaxes, and people are now putting a lot more barrels on Suezmaxes instead of the Afras, and Afra rates had jumped materially and they started moving to Suezmaxes, so there's more demand for Suezmaxes out of the Atlantic and there's less ships, and those rates have skyrocketed now too. So we're seeing the impact benefit the Suezmax segment overall, but we're also seeing the uptick in demand for Vs too. So when I look at the count of Vs in the US Gulf Coast, Brazil, WAF, they're all less than 50% of the normal counts. And also when I look at the fixtures, I'm seeing what you're talking about. There's incredible demand coming from India. A lot of the WAF VLCC fixtures are ending up in West Coast India and East Coast India.
Interesting.
And this is really pushing DPP values higher in the Atlantic.
Yeah, which at some point should have an impact. I mean, we'll talk about diesel, and I guess that the LR2 market must be also quite strong. I got feeling, I haven't checked, but I assume that it would be the case. No? So the other story obviously is Russia, and Ukraine keeps attacking with drones. The latest news that we've seen is in the Taneko oil refinery, and I'm reading out of a script here, but these names I cannot say. Taman-Nefgas oil terminal in Krasnodar overnight. That happened overnight, but the bombings are a bit everywhere, and I was just looking at what is the impact, and I have it here in terms of Russian supply. So apparently at least 17% of Russian processing capacity is down, or roughly speaking 1.1 million barrels a day is currently shut. And the run estimates are in Russia something like 3.6 million barrels according to Bloomberg, a 24-year low. So, I mean, it's quite remarkable. And obviously the story here around Russia is mostly around diesel. In the same way that Hormuz is mostly around crude, Russia is all about diesel. before we come back and to Red Sea, because obviously it's a never-ending story, the geopolitical tension. But maybe you want to talk about what is the impact on the diesel market and what are you seeing right now, James?
Yeah, well, it's an interesting one. And for many of the factors that you've highlighted already, it's really kind of difficult to construct a bearish case for diesel at the moment. We've had these Russian diesel barrels that have been sanctioned into most of Europe, although Turkey was taking quite a large amount, and into the US as well. But as you say, this Russian diesel has been finding other parts of the globe to fill, and now it's not flowing. Those have to come from the US Gulf or West Coast India. So it's adding just a bullish tinge to everything. I mean, saying that though, I do have in the very prompt on a very short-term bearish view on ice gas oil spreads, probably more than the cracks. We've got severely depleted stocks for diesel pretty much everywhere. Spreads, cracks particularly, are just ridiculously elevated at the moment. I think we saw the US heating oil crack over $100 per barrel for August and close to for September as well. Let me just read out some of the other numbers as well. We've got September SEP-OC ice gas oil spreads over $45 per ton. We've got the September ice gas oil crack over $80 per barrel. We've got September heating oil cracks outdoing those, close to 100, as I've just kind of said. And all of this is seemingly driven by the crises that you've kind of highlighted in the Mideast, but also in Russia. Added to this, and I think why things pricing in the medium term is set to be very bullish, we've got impending turnarounds in Europe, North America, and much of the Mideast. Now, you would imagine that refiners would be looking to minimize this refinery turnarounds as much as possible. Refinery margins where they are, mostly propelled by diesel, although gasoline is not looking that healthy stock-wise either. Jet, on the other hand, is probably the one refined product that looks pretty loose now currently, at least in the US and perhaps East Asia. If you kind of look at some of the kind of Singapore regrade pricing. For example, Singapore regrade for September is down to like minus $5 per barrel, like a very seasonally low number. August is even lower. The positions of regrades, the GOFOs, even the Widowmakers, so the spreads with gasoline, are just, and combined with stellar refining margins, just every kind of lever that can be turned now is trying to be turned to make more diesel. But I guess I think in the medium term, it's not going to be enough.
Yeah, no, again, no surprise. But I mean, I was shocked when you said $100 a barrel. That's like, you're double the price of crude, essentially. Yeah.
Yes.
Even more.
I've never seen a number like that.
We see all kinds of all-time highs and everything. But again, is it surprising? Not really. I mean, when you have the supply shocks that we've had, it is not that surprising.
Well, particularly for diesel, so I'm speaking of you, but particularly for diesel, it just kind of feels like the last few months, even probably more than the start of the crisis, have been just the worst case possible scenario. So we've eaten through all of the kind of diesel buffer that we had in March, for example. We've added the added continuing reduced refinery runs in Russia, the continuing issues in Mideast that the US can't really step in now to mitigate. You've really seen the effect in diesel pricing now.
Of course, I mean, it just keeps compiling. There's more and more bullish news that keep coming up. In the same way that when the war was declared or the first attacks, there's all kinds of speculation and exaggeration, like we saw on the jet regrade or many things. The reality is that there were ample stocks at the time and all that. So that was more speculative. Now it's just facts. The stocks are not there, and there keeps being one after another in terms of bullish news from the market. And we need to see a stop to that. Otherwise, I mean, we'll talk about gasoline later on, but there will be, of course, some sort of 1 week drops and things like that. But the fundamental story is still there. But how does this? What does this mean for arbs or the flows right now for diesel globally?
Yeah, thanks. I'm going to go through that now. Maybe if Michael wants to jump in and interrupt me about maybe TC14 or TC5, please feel free. But after a long period of being open, I guess the first 2 or 3 weeks of August, or maybe more specifically the first 2 weeks of August, the transatlantic arbs, which were open into Europe from the US Gulf, even surprisingly from the US Atlantic coast, and we've seen the kind of large numbers of shipments, those are really closed now. So that kind of water that was already loaded, that diesel was already loaded on the water and is on the way to Europe, should continue to weigh on ice gas oil spreads, I think, in the very, very prompt. But in the medium term, strength in the HOGO has completely shut these arbs and continues to point to that medium-term strength that we've been speaking about. Our arb numbers and the US part of our team indicate that there's an increasing pull for US diesel barrels into Latin America, specifically Brazil, in place of these lost Russian barrels, kind of something that you were alluding to earlier. And this has also helped to continue to strengthen TC14 as well. Maybe Michael wants to touch on that later. We've also got West Coast India diesel LR2 arbs increasing in volume west because of the extreme width of the gasol east-west. And really, West Coast India jet LR2s, if anything, are kind of outdoing them and are really firmly open into Europe now. Red Sea arbs.
Can I ask a question on that? Because I saw that were more attacks on the Red Sea. Is that impacting the trade route, or are they going via Cape, or is it still flowing through the Red Sea and Suez?
It's still flowing through the Red Sea and the Suez from Yanbu loaders. That's not that distance flow hasn't really.
And West Coast India?
But West Coast India is going by the Cape.
Okay, fair enough.
And that's really a situation that has been going on since the Israel-Hamas Nova festival.
Yeah.
Like the last 2 or 3 years. We've also got Red Sea jet arbs firmly open into Europe. Quite a difference to diesel, actually. And kind of interestingly, diesel arbs into Singapore also look very closed at the moment as well. And that's kind of, I'll come into the trade. Let me just flow into the trade calls anyway. So I've got a kind of very, very prompt bearish view on ICE gas oil spreads. But that increasing pull for US diesel barrels into Latin America in place of Russian barrels, as well as the strength in the HOGO and just the strength in the US diesel complex in general, leads me to have like a medium-term bullish view on pretty much all diesel, to be honest. But ICE gas oil spreads, heating oil cracks and spreads. The US diesel stocks now look particularly low. And this is a story also in gasoline. But if there is no export ban on refined products from the US, which was something we spoke about for a while, but has to be on the cards a little bit, the expectation is then if that doesn't happen, then we're going to have to see continuing strength in heating oil spreads and the HOGO as well. Now, on the flip side to that, we've spoken about just on jet about open arbs on jet everywhere and healthy stocks for jet pretty much everywhere. I think there's more room for global regrades to move down, to continue to open these Asian jet arbs into Europe. But also we've seen US Gulf jet arbs closed into Europe currently, which Europe is going to, in some respect, need this jet supply. So I would expect US regrades to come off as well.
Fair enough. Anything else on diesel?
No, I don't think so. But I just think that the impending turnarounds globally and the kind of rising demand for diesel as we head into like end of Q4, start of Q1, I think things are going to start to look pretty bad. But I just really want to add the caveat there that at the start of the crisis, we had that kind of similar view about jet and things got bad on jet. Jet pricing blew out. But the market did find a way to efficiency gains to deal with it. So I guess SPR releases, perhaps. I think there's less buffer in middle distillates now, but I think that's an important caveat to mention.
Well, I mean, it's the famous story of this is too big to fail and we need to find a solution. And it seems like the only probable solution over the next months is this sort of like détente for a month. People rebuild stocks. They rebuild not only stocks of diesel, but also stocks of bombs and drones and everything you want. They reorganize themselves and then we go back at it, and it seems like that's the only way to sort of contain the situation, but there's no end in sight. But yeah, and on your side,
EasyJet flight for only 18 euros recently.
Yeah.
So
flights are still cheap.
cracks
Yeah,
are
remember
strong,
we
but
were
they're
talking
not that
about
strong.
the end. Book your flights for summer, when we were in May. But yeah.
Let me jump in with freight because James, you spoke about the diesel and Russian issues and attacks and everything, and it's really turned the Northwest Europe MR market into complete garbage.
Okay.
There are so many ships available, and there are a lot of companies, enterprises that are fine with Russian history. So because the diesel's not coming from Russia anymore into Western Europe, those ships are available. And now they're taking more traditional business. So when you combine that with Europe not really exporting very much anymore because they can't and they shouldn't, what we're seeing is just a large number of intra-regional fixtures. So you have your cross-med MRs that are taking handy business because your MR rates are so low. And then you're just seeing a lot of UKC med UKC runs. And the issue with this is the ships are only employed for 10 days or something. So you fix the ship and then it immediately reappears on the back of the tonnage list. And TC2 rates are at 6 months lows. And I just don't see any catalyst over the next few months for TC2 to rally or for European MR rates in general to rally. But on the flip side of this, it's taken your 12-month long-term TC charter rates lower. And if I was a ship owner and I wanted to get some length, some physical length without waiting for new builds. These are starting to look like attractive entry levels to take a 12-month TC. And if you take that ship delivered into Europe, you don't have to keep her in Europe. You can take her to the US Gulf Coast or to do runs into LATAM. I'm just starting to see some interesting opportunities outside of trading spot in the next 3 months in paper.
Yeah, I'm talking about the TC2. Obviously, we saw that the ARB completely shut down from ARA to New York this week. Maybe that is also influencing the market because we did have a couple of 2 or 3 weeks in a row with open ARBs. I would suspect that we will see quite a lot of volume going there into New York. But did you see the fixtures or?
I've not seen very many gasoline fixtures into the United States Atlantic coast for about a month now. The naphtha ARBs have been open, implying some blending, but I've only seen maybe one naphtha fixture a week. So the only long-haul demand I'm seeing regularly from Europe now is into WAF, just gasoline barrels going into WAF. Everything else are these 7 to maybe 14-day type voyages intra-Europe. And that puts a lot of pressure on the US Gulf Coast MR market to perform, because if you're mainly an Atlantic ship owner, where can you send your ship? It's really just the US Gulf Coast now. And what this has created is this massive yo-yo swing effect where all of these non-traditional type ship owners ballast their ship to the US Gulf Coast. They don't really know how the US Gulf Coast trades, and they're the first to go below last done levels. So then the market starts to turn over and tank, and then they dig their heels in, and then it rallies too much, 100 world scale points, and it just is constantly yo-yoing back and forth. And it's not good for the ship owners, but it's also extremely hard to trade if you're a product trader.
Anything else on the freight side of things?
Just that finally the Singapore region has turned a corner. They're now a bit short on MRs. The ARBs loading out of Singapore are now much more attractive than, say, West Coast India loading counterparts. So when I look at ARBs delivering into East Coast Africa and South Africa, Singapore is now the best load source. And that's usually not the case. I mean, you can exclude the AG loaders and just look at West Coast India as a competition. It's almost always now West Coast India that delivers best. Currently, it's Singapore by close to $5 a metric ton, which is impressive. So we'll see more demand for MRs out of Singapore over the next week or two.
That's very interesting, actually, because you can also see those MR ARBs from Singapore very open on jet into the US West Coast as well, I guess, for similar reasons. Yeah, very interesting.
So somehow Singapore, they seem to be long product now. Just in the last 7 to 10 days or so, these ARBs have started to improve.
It is a ship, although not the type of ship you would imagine, the barge market. You've all seen the news on the Rhine levels and all that. I can only assume, I just came back from holidays, but I can only assume that the barge rates are stratospheric right now, no? And you can only load at 70% capacity, 60% capacity, 1 KT barges instead of the 2, 3, 4 KT barges. Is that affecting creating even more of a stress on the diesel market in ARA?
Yeah, I think that has added to actually a little bit of the bearish tone that I spoke about on distillates, on ice gas oil spreads before, actually. But I kind of always feel that one is a bit of an overstated view. Kind of during my time at Shell, actually, what you would happen to see is when these Rhine water levels went down, is that we would just move similar amounts of diesel just on more barges. And that's why we would see barge freights go up. So much. And actually, I'm sat at the mouth of the Rhine now, very close to Rotterdam. We've had about 3 or 4 days of rain. So that should be alleviating that issue very soon.
Yeah, no, it's the opposite on gasoline. In gasoline, it's because you're exporting and essentially you're getting all of these barges of gasoline coming to ARA to be exported. It's the other way around. So gasoline prices go up and export levels go up, etc. So it is having an impact on the gasoline market. But moving on actually to gasoline, I mean, pretty much like diesel, the fundamental story everyone knows, we're all-time highs on pretty much everything. You name it, spreads, cracks, all-time lows for east-west, etc. No, I would say the only significant news this week has been the collapse of the TAA ARB on paper, not the physical ARB, but the TAA ARB, going all the way from 20 cents per gallon at the beginning, or I think it was end of July, to now only 1.65 cents per gallon. So quite a significant drop. We obviously saw TC2 collapsing from 185 to now 108, I think it is, on TC2.
Yeah.
So that's, probably not only linked to this, but it's obviously exacerbating that problem that you have on freight, on MRs. We saw that the ARA ARB was pretty open, maybe 2 or 3 cents per gallon open into into New York for the past 2-3 weeks, and then since last week it shut down. Now it's closed by 5 cents a gallon for blenders, although it remains slightly open for Northwest Europe refiners. And that's essentially what we're seeing in the market. No, so it's the U.S. is having a sort of moment of pause. They will be receiving some cargoes from ARA. I would suspect you're going to see that in the fixtures soon, because this was arbs for September arrival booked 2 weeks ago. So you will see an uptick there on freight demand probably next week or something like that into New York, but that is already priced. And now we're starting to see a moment of pause. I think that every single person in this market should be long. And when you have a moment like this where you're thrown a curveball and now suddenly the US is saying, well, we have enough, and the market starts coming off a little bit. We've seen the spreads come off, cracks a little bit come off, but since yesterday only. So it's very early to say. We cannot call this sort of a reset or anything like that, but I would not be surprised in an environment where everyone is long that we have 2, 3, 4 days of a bearish momentum. Let's just, a bit like what you were saying on diesel.
Yeah, it sounds very similar. Yes.
By all means, I would never be massively short here, but it's one of those things that I wouldn't be surprised that if you call a broker today and he has more offers than bids right now, Now, is that going to create any kind of panic? Well, maybe. I don't know. I don't think so. I think the underlying story is still there, but the levels are stratospheric. We almost touch $100 a ton on spreads for CEPOC. We were at 99.5 or something like that. I think that the market still wants to touch the 100 mark before it goes down. But that's what I would say. It's like we're seeing a moment here where I would not be surprised that you have 2, 3, 4 days of, to a certain extent, crude taking over in terms of the bullishness. You start seeing that the cracks are now a bit coming off a little bit and crude going up and doing the job. Flat price remains high and elevated, but it's more the crude that is doing the heavy lifting instead of the products. But again, short-lived, in my opinion, very short-lived. On the physical side, again, we see some sort of bearish momentum. As I said, all of the arbs now, transatlantic, are shut, and to New York, Mexico, Canada, everywhere. Gulf Coast is basically dominating the Atlantic basin, except for obviously Nigeria. We also see E10 margins are very positive for August, slightly positive for September. E5 blend margins are open in August, but that's it. So I wouldn't be surprised that you start getting a little bit of a push from the market and people taking advantage of selling at this kind of levels. And depending on how deep the bids are, this can go much deeper, lower, or not. Interestingly, I was looking at Q4, if there's any opportunities there. I saw that ARA is actually quite cheap. Now, depends, we obviously make a forecast of freight, but it's difficult to forecast, freight in Q4 right now. But given what you were saying about the weakness in the freight market on a forward basis, it seems like despite the extremely low East-West right now, arbs into East Africa, South Africa, even Iraq seem to be open from ARA, or at least break even relative to Singapore and AG. Not necessarily something that you can book or lock in advance, but at least it tells you that there are some opportunities to buy spreads maybe in the back end of the curve.
It's interesting, this real strength we're seeing in gasoline, but still it's not really competing with diesel. I mean, I was just looking up the numbers now. We've got like the RBHO swap in the US trading September close to minus 140 cents per gallon. I mean, just a ridiculous number. I understand the bearish sentiment you just said then, but surely you'd have to see gasoline kind of price up a little bit to try and bring these yields back. I guess maybe that's more of a medium-term story, but
I mean, what you're describing here is in a market where you have two very bullish products. Which one is more bullish than the other? And do you really want to? I mean, I think that the safer trade is to trade relative to crude or relative on time spreads or East-West. As a gasoline trader, I don't really follow that much diesel, so I'm relying on what people tell me. And in times of crisis, in times of supply shocks, diesel tends to be the main market driver. So it's the most non-negotiable product out there relative to gasoline. So I'm not surprised that diesel is outperforming gasoline. Now, do I want to trade that spread? No, I don't want to touch it. But that's about it. I mean, on gasoline, it's the fundamental. It's very similar to what you just said on diesel. Fundamentally, still the same, record high levels. The only barrier is the mental barrier. And now we're touching a bit of a ceiling, and let's see if that retraces back or not. On naphtha, and I'm reading here the notes from our good colleague or good friend Jorge, The physical market has shown some weakness. Interestingly, Asian cash dips have dropped $50 a ton over the last 2 weeks for the second half of the September deliveries. The last trade shown them around $12 for deliveries into Japan and Korea. On the arbitrage side, it is now closed from west to east, with both Europe and Gulf Coast have no opportunities right now to move into the Asian market. East-West is up $10 a ton, on a week, but as we just said, not enough to open up that arbitrage. So again, it's a weakness on the naphtha market as a whole, and despite weaker freight, despite a higher East-West, it's not good enough to make those arbitrage there. So maybe this is the only weak side. And again, if I had to put in a trade, it's more on gasoline versus naphtha. You see things like that, So the market looks biased to the downside in the short term, with global cracks and time spread pointing to keep the current correction. That's essentially what Jorge was saying, especially with Asian tip cracker maintenance in September. So we don't expect a lot of naphtha arbitrage volumes into the east, over the coming weeks. That's maybe the trade, as I said. Although, as you know, all-time highs maybe not all-time highs, but extremely high levels for gas naphtha as well. And I think that's it, no? Unless there's any other comments or...
No, that was great. Thanks very much.
Just one last on the sort of macroeconomic, I don't know if you followed, but there's been more and more intervention from the US government on the bonds, and we're now at 6 months low on the dollar relative to the pound, the euro, etc. So generally that's another push for commodities. So I wouldn't be surprised that the macro funds are now buying into commodities to hedge the dollar exposure. So that's just another bullish momentum happening in the market.
Yeah, very interesting.
That's on me. So thank you, Gary. Thank you, guys. Thanks for your time. I appreciate it.
Yeah, thank you too.
Thank you.